And if we could just start with the discussion with Olga again. You mentioned a few assets that can be tokenized. You mentioned art, real estate, venture capital, private equity. Which of these sectors do you think has the greatest potential to really lead in this space? I mean, which will really break through next year, for example?
My favorite is, of course, venture capital and private equity, because with this one, if you have tokenized assets, you can also create, funds of funds and do all the stuff yourself, right? You don't need UBS, you don't need any other intermediaries telling you, like, we will put a portfolio for you. So this is great.
Great. And then, if I just want to get a sense from the three of you on where we stand with this today. I mean, there's so much talk of a bubble. I'm interested to hear all of your opinions on this. If we can start with Matt.
Sure. Well, bubbles and effervescence and froth are what's needed to create infrastructure like blockchain or paradigm shifts like cryptocurrencies. And bubbles in railroads, telephony, internet, you can't put a number on the table to say, in order to develop all the bridges, roads, and tunnels, market adoption, education, it's going to cost this much to do it. Everybody like, that's a crazy number. Nobody would sign up for that. But fear and greed and kind of getting into this effervescence, that's what forges these infrastructures. And so, bubbles are good. It creates new economies, new infrastructure. I think you put today in perspective. So a year ago from where we're sitting today, this market cap of this cryptocurrency space was about 20 billion. Today it's about 300 billion. And then people like to use the internet as an example. And the internet's interesting because people got kind of excited about putting pet food and women's shoes and office supplies online. That was like a big deal. People were changing the world with that, which is, I thought, kind of funny in context. Now, we're talking about money, identity, distributed, cooperative systems that are decentralized. You contribute, you get something back. And it's like an amazing thing. And these are now trillion-dollar networks that are getting developed right in front of our eyes. And so while people say, hey, there's some froth or, this is a hot market, I think, we went up to 20 billion to 300 billion, which is pretty heated. And then you look at the other side, the blockchains, not only blockchains, the throughput, utility, adoption, and what's happening. Are people putting balance sheets and doing trading settlement, all that stuff? That is ho-hum at best right now. And people are, but yet the undercurrent to this, people are building a lot of stuff, a lot of functionality, a lot of applications and education and getting that bite. Once this flywheel starts turning, this 300 billion is going to look silly low. It's like a 10x, if I could just put that out. Once you see some proof of life and some indicators here, so that's a 10x right there. And then you think about most of the people, in this 1, 3, 5 block radius, aside from this this conference floor, have no exposure to crypto. That's another 10x. Once this wall of money comes in, and my neighbor or hairdresser or whatever has crypto. And so we're in the early days. It's exciting.
Great.
Charles, do you want to follow?
Sure. Okay. Can everybody hear me?
Yes.
Okay. Project my voice. It's a scam. We're all going to jail. No.
I'm here to defend you.
So we have lawyers already.
All right. We can use some of that crypto money. I came into this space when Bitcoin was very small. In fact, the very first conference I went to, there was a guy named Bruno who came up to me, and he's about 6'4", and he was wearing a pink tutu, and he hugged me. And I said, this is crypto, and Bitcoin's less than $1. Now it's at $10,000 today. So from one perspective, any asset that goes up way too quickly tends to go down very quickly as well. So if you look at it in the short term, probably things are overvalued, but they always get overvalued when you have new technology. The real value comes from saying we can now do things we could never do before. For example, capital controls really don't matter very much anymore. So what's the value of that? What's the value of protecting yourself from civil asset forfeiture or being able to disintermediate your identity and your property rights from the government you happen to live in? I don't know. What's the value of being able to crowdsource infrastructure? I was just in Barbados, wonderful place, and the hot topic right now in the Caribbean is all this damage these hurricanes have caused. Hurricanes can also be a blessing because they destroy a lot of stuff and they give you an opportunity to rebuild, and you can rebuild differently. So maybe they're going to have utilities that are actually owned by the people. Well, maybe that requires a crowd fund to do a utility. Well, that means you'll be selling a token to do that, right? Now, this is something that the Caribbean has available to them they didn't have the last time everything got devastated. So it's a mixed bag. The age of regulation will soon be upon us. There'll be a crackdown that's going to hit the markets pretty hard. We'll get through it like we always do. And on the other side, I think that this market will continue to grow and continue to be strong. And overall, I have a belief we'll be in the $1 trillion range in the next 5 years to 10 years. And at that point, it's just another asset. Just like when the age of structured finance came, and they gave us all these really exotic assets, some of which caused problems that we're still recovering from. But every time you get a new asset, you get new capabilities, and also you get more inclusion. So right now we have markets that work well for about 4 billion people, not 7. This asset will close that gap and eventually give us markets that work well for 7 billion people after we get through the age of regulation and after we get through all these growing spurts and pains. So I always look at the long term. In the long term, I think we're not in a bubble. This is just the beginning of a new industry.
Yes, and maybe just to add to this point, being based in Switzerland and living, through this, banking, this banking secrecy in Switzerland in a way, but actually that was a place, for privileged people to hold their money in safety, right? And now this, secrecy is going away. But even still, like if you're not rich, you have no opportunity to hold your money with a Swiss bank. If you're 5 million plus, yes, you're welcome. But what about the rest, right? So for the rest, now there is a cryptocurrency. And it doesn't have to be legal money, or it needs to be the same KYC and so on, but it's now democratized.
Yeah, it's like privacy, security, and access now are available, like life, liberty, pursuit of happiness. Those are like big deal, change the world kind of dynamics. So.
Yeah, exciting.
Great. So we've seen this evolution of tokens start really with Ethereum. I mean, many of these tokens kind of exploded from Ethereum as a base, and we saw this kind of evolution from application tokens to securities tokens. And so, Charles, interested to know your thoughts on where regulation comes in each stage.
Right. So we created a monster with Ethereum, right? No, it's just new technology. Okay, so the issue is that first you have to separate the primary offering from the actual tokens that are trading on the market. So there's primary market and secondary market. So a lot of these ICOs, when they're selling X, FooCoin, let's call it, that has nothing behind it. There's no tech, there's no project, it's just very early days. So that would look probably like a securities offering in a traditional sense. But then eventually, let's say you actually deliver a product and now there's a token trading. Is that token that's trading also a security? Is there transitivity there? And that's one of the great challenges that we have to overcome, is to figure that out. The second thing is that even if there was a regulatory crackdown, this would only be done in a regional sense. The United States is a big region, but the world is bigger. So, crackdown or not, these types of tokens are going to continue being issued, continue being traded, and what's going to happen is an arms race, where we're going to see a huge investment in decentralized exchange, a huge investment in privacy technology, and so it's going to become more and more difficult to know who's even issuing the token, and who's even buying the token. What jurisdiction do those people live in? Most regulations are bound to a jurisdiction, so that's going to be challenging. But I do believe there's going to be some form of enforcement, because you have basically people now offering ICO in a box services. There is no, it's all just semantics and structuring and so forth. And when you see these types of structures, maybe they're legitimate, but 80 or 90% of them will end up just being me too, right? And there's just no way these people will succeed. And you're dealing with the worst possible investors. When Matt has his investors, I have investors, we deal with sophisticated people, where if they lose money, they're like, okay, well, it's a game of numbers. Not everything's great. When you deal with a very unsophisticated investor who makes $30,000 a year, and they've just put their life savings into this is their only investment. And they have unrealistic expectations. They say, oh, well, it's got to go up 10x or 100x in the next 2 years, or unless, if it doesn't, it's a scam. Name one investment class that goes up 100x in 3 years or 4. You can't. You get lucky when these things happen. So when you have that kind of an environment, you have these classes of investors, you have the fact that the majority of people raising money probably ought not to be raising money the way they are. It's an invitation for regulatory enforcement. So I very firmly believe it'll happen. Then what will happen is, predictably, there'll be camps. The really privacy, anti-government camps will invest heavily in decentralized exchange and privacy, and they'll continue doing things the way they're being done today. Another group of people will focus on compliant ICOs, and they'll work out a deal with the government to do that. And another group of people work on regional ICOs. They'll say, instead of trying to be everything to everybody, let's just sell these tokens within a scope market and create liquidity within that market. And these camps will all just operate. And then the fourth group are the people who refuse, and they just keep operating brazenly, and then they'll be talking to him in a little bit.
Yeah, there's going to be a lot. I just echo what Charles was saying. There's going to be a lot of regulatory arbitrage, and what's interesting, like, who would have predicted Bitcoin 10,000 with China banning everything under the sun?
Dave Johnson did, actually, 3 years ago.
He did?
Yeah. He said they were going to ban it, and he said it was going to be 10,000. So he got it right. You got to give David that.
But generally, that you wouldn't expect this market to get
Right.
this, because a lot of the Bitcoin mining, trading, volume was in China, and that got displaced to other parts of Asia and beyond. So that's interesting in terms of jurisdictional arbitrage. And regulators, I'm also serve as chairman of the Chamber of Digital Commerce, largest trade association, and we deal with regulators all the time. And the U.S. hasn't figured this out. It's a regulatory patchwork. It's really a lot of friction, state by state, all the different agencies. But smart regulators that will say, how can I displace Silicon Valley? How can I displace New York? That's actually possible. People talk about that all the time. I want to build new Silicon Valley and whatever. But this is actually possible with these networks and these ecosystems and infrastructure that's being built. And so it's something to pay attention to. So there's going to be action and reactions to this. The other dynamic, there is a lot of, let's just say, froth and crappy ICOs out there. And we as a community need to put our best foot forward to say, hey, let's start thinking about frameworks, best practices, and kind of self-regulate ourselves. And part of this platform called the Token Alliance, which was, to Charles's point, this regulatory hammer is going to show up. And when they show up, the pendulum swing is kind of, is usually overdone and will create jurisdictional arbitrage. But if we, as a community, say, let's self-regulate, let's, when we do token offerings for teams, let's do a lockup. This is an open source lockup mechanism, let's do that. Treasury management, all this auditability, transparency stuff. Well, what does that actually mean? What can I see? What am I going to be shown? All these things will delay some of that regulatory friction that's going to be upon us. That's a really big deal.
Yes, and we are working on the same initiative in Switzerland. A lot of ICOs came to Switzerland to use the regulatory environment where, even if it's security, it's not treated in the way as it's treated in US, right? And we've seen, I guess, out of 7 biggest ICO, 4 of them were in Switzerland. Right, and obviously, also FINMA, our Swiss financial regulator, started investigation currently, like around 25 cases. 3 have been already shut down in a bankruptcy case, right? And we in Switzerland, we are creating so-called ICO SRO, self-regulatory organization, right? We have a code of conduct, 10 rules, and if you're happy to apply with them, welcome to the club. And if not, then... And I think, like in Switzerland, we as a country, which is, probably one of the most decentralized democratic societies, right? We love self-regulation. Even in financial services today, a lot of it going through SRO. Right. So that's the next logical step.
And one more thing, just to what Charles mentioned earlier was autonomous systems. This is actually where regulation and, turning off the internet or those types of things that you just can't turn off. So I always call private blockchains training wheels for public blockchains. And on public blockchains, a lot of them are in some ways training wheels for these new autonomous decentralized networks that just operate and work, and you trust the math and everything else, and there's no miners or a community of developers to worry about, things that just work autonomously that are launched And what jurisdiction does that mean that they're in? It's like, I guess, outer space or whatever. But those are going to be some of the most powerful networks that we'll see, because the code is written, it's unstoppable, and it's provable, and it's trustworthy that way. So that's like the next layer of thinking in terms of these layers that are going to get developed, where you have less of those existential risks with that particular protocol or application.
Yeah, I mean, that's a great top-down macro view from the three of you, but I'm wondering if the SEC comes out tomorrow and says, we'll say for now that all of the tokens issued as of today are securities. What are some of the practical implications that you think can happen to securities, to tokens that are already trading today, and to the investors in these tokens?
They just can't do that. It's not practical. The reason being is that taking that position would mean that every person who's traded the tokens is also in violation of the law and would require some form of broker-dealer license. So that would mean, by extension, they would be throwing hundreds of thousands to millions of people out of compliance. So they have to take a more measured approach. They have to do something, but it's going to have to be in a targeted capacity. If they were to do a broad crackdown, there are so many unanswered questions about this. They'd have to go after the exchanges, the people trading on the exchanges, the issuer of the token, all the financial service businesses, including the banks that have assisted these ventures. Like if you have a bank account, then they would be hit too. So that's a bit too broad of a brush. But what they can do is start being very strategic, which is exactly what they've done. They started with kind of the thing that everybody hated and wants to beat up, the Dow. And say, all right, here's our argument of how things are securities or not. And by the way, we're going to imply that at some point we're going to start going after these things. And then they started going after some small, inconsequential ICOs. And what will probably happen is they'll use some sort of flagship case. Some large ICO that has some bad press and maybe already has class action lawsuits. And they'll say, well, these people have made the case for us already that there's a security, there's U.S. participation agreement. And then based on that, that'll become the policy. And then they'll create some sort of jubilee so that people who are out of compliance have a way of getting into compliance. And then say, moving forward, you can't do what you used to do. That's the most likely outcome given the way the SEC has been acting and how they approach these problems. I don't think a broad crackdown is practical. On the other hand, I don't think they can continue to wait. There's going to have to be, because of the way the numbers are working and how much money's been raised, there's going to have to be some form of enforcement the next 6 months to a year, in my view.
Yeah, it's of consequence now. I mean, and Charles is right. I think the genie's out of the bottle, so it's kind of hard to just do anything there. But we're also seeing new bridges, roads, and tunnels being built, like what T0 is doing to be a regulated exchange, so you could do that compliantly, and platforms like Polymath Network, which is doing compliant equity issuances that are tokenized. And so we're seeing a new kind of evolution of doing this with compliance. And so, it's hard for the state of Wisconsin Teachers Pension Association to get in crypto because all the form factors, all the regulatory things are just weird. But once some of these things are solved and they see compliance and they see regulatory clarity, then again, a whole new wave of money comes into the space.
Great. So this sector or asset class or whatever you want to call it is still very much in its infancy, obviously. What are some of the infrastructure that's missing for it to really, become more mainstream or kind of support the level of transactions that could really, make it take off?
Well, there's like two questions there. So the first question is what's missing, and the second question is about consumer adoption. So missing from a technological viewpoint, we're right now living in a replicated world, and that gives you tremendous resiliency. So it's like DNA in a certain sense. You're just copying it cell to cell. Okay, well, the problem with a replicated world is you gain no resources as people enter the system. Okay, so if you go it's like adding more chairs around a table with a pie. Adding more chairs doesn't make the pie any bigger. It just means everybody gets a smaller slice of pie. And that's what's going on with Ethereum, Bitcoin, and all these systems. So the first challenge is how do you turn them into a true distributed system, a true scalable system, where as you add people, you gain resources. And that's both on transaction processing, the network, and the storage side. The good news is we know how to do this in theory, and it'll take a few years for that to get rolled out. But that'll organically happen. Okay, so once you achieve that, then you can scale to millions to billions of people, no problem, because people eat what they kill. Then in terms of consumer adoption, you need first legacy infrastructure to find a way to integrate these things, kind of like what happened with the VoIP revolution. We had some VoIP for a while, and it was kludgy and weird, and then all of a sudden now it's in Facebook Messenger and everything else. It just organically kind of comes in. So you need some legacy adoption. And then you also need to have consumer protections put in. So this is kind of a difficult balance, because on one hand we're saying you're in total control of all your money, so much so that you can just do whatever the hell you want to do with it, and you can take it anywhere you want to go and evade capital controls. But then on the other hand, we also want backseas and mutability and everything else when it suits us, right? So how do you balance these two things that are living on the opposite sides of the planet? So this is where trusted third parties come into play, and good regulation comes into play, and potentially the use of smart contracts can come into play. And if you have good crypto with good smart contracts, with good regulation, you can find that right balance and that teeter-totters. And then once you have consumer protections, you won't have a scenario where somebody can suicide a contract and lose $150 million of value or something like that. And I think that'll make it much more consumer friendly. And then it'll be easier for enterprises to adopt it and bring it into their portfolio and layer their products with it.
Yeah, I think the form factors today are still a bit scary in terms of like the wallet. You know, we all have a wallet or 2 or 10, and they're all kind of still not as good. Certainly, like 2 or 3 or 4 years ago, when I thought like what the wallet would look like by 2017. That would be like, you know, your browser to the blockchain. You have every coin, everything all set up, and it's still.
We're changing that with Deadless. It's going to be amazing.
Yeah, I mean, so there's a lot of great, you know, multi-token, multi-currency, multi-protocol wallets that are developing, and some of those form factors are really important. And then, to Charles's other point on security, it's like, yeah, we're not really good at managing literally our own raw money, like on a phone. And so some of those concentric circles of security and insurance and insulation to say you have velocity limits, like, you know, if it's over $100 a day or $1,000 a day, it needs to do X, Y, and Z or notify you, and have all these different ways in which we manage our money differently. And that software and a lot of those form factors to provide better security is there. It just needs to get embedded and developed into these wallets. And, you know, like people always ask, how do you manage your crypto? And my answer is none of your business. But there needs to be better public best practices to say if you got, you know, 1,000, 10,000, 100,000, $1 million, whatever, what you should do at every kind of juncture and form factor. Because today it's like it's a black art. You know, it's like, oh, do you print out a private key on a piece of paper, acid-free paper? Do you etch it in this? Do you put it in a ledger wallet? What if you lose it? All these things are off-putting for most people. And so if you could find good, smart, multi-coin wallets that have some of those insulation layers on top of it, that will, again, help drive some of the adoption, because it's otherwise pretty scary.
Okay. So let's open for questions from the audience. Anyone have any questions for the speakers?
Ooh.
So you're not sleeping.
This is the fun part.
Should we get somebody to hand over a mic?
Who was first? Start over here, then go in the second.
Can you each comment on how do you bring, let's say, the real world and the token world together in when you talk about specifically about funds and bridging the token economy with the asset economy that's underlying it? What models have you seen? What works well? What's the development on that area?
Sounds like an Olga question.
Yeah.
Oh,
And then
sorry.
assets. Maybe.
This one again. Thank you.
So I think, you know, in finance, of course, it's still about trust, right? Who is recording the ownership of those? And I think, you know, the regulatory environments that we have today, this is actually what we need. It's already in place, right? You just need to adjust several requirements, like speaking about exchange for tokenized assets, right? those cannot be the same requirements. For example, for ICO, for tokenized equity, those cannot be the same requirements that you have with the Apple company, right? And this is going to be kind of like more, I think, again, regulatory race. So which country, which regulation will move forward faster to adjust? And we have a lot of great examples today. Gibraltar is moving forward with a blockchain exchange, right? The same in Switzerland, and in Liechtenstein, there is a will to create a new regulatory framework for crypto finance, right? So I think smaller countries will be, have a competitive edge to move there, and that's all about it. But guys, since we have only 10 minutes, maybe let's move to another questions before we all.
Oh.
Sorry, I came a little late, so you might have covered this. What's your opinion of the SAFT contract? And what do you think about the rebuttal that Cardozo Law came back with in the past couple of weeks?
So SAF, the simple agreement for future tokens? Correct. Yeah, okay. So it's going back to what I said earlier about the separation of the primary offering from the secondary market. So I guess what they're attempting to do in principle there is saying, okay, well, I need to raise some money, and that money is for project finance, and it's going to allow me to build something. Under ordinary circumstances, that would be done through a regulated traditional VC-style notion or through personal investment or friends and family, right? So what SAFT, I think, is trying to do is say we're going to play with a special group of investors who are smart money, and they're kind of in a different bucket, right? They're Reg D exemption. And then this in some way won't transitively contaminate the token when the token launches, so that we can still say the token's a utility token and anybody can buy it and it can trade on these exchanges, but the initial offering was somehow different. There was some other thing that was being sold there. Now, as for the particular analysis that was done, it's a pretty good one, and it makes a fair argument that that's probably not going to hold up. And so I think that at some point there's going to be some litigation, and at some point there's going to be some enforcement, and then all of these schemes will be able to compare themselves based upon where the case law sits. But that's just going to have to work its way through the legal system and through the regulatory system.
Yeah, I'm not a huge fan of it. I think trying to hermetically seal that pre-ICO financing is also is not as democratized, not as open as you'd want it to be. And I think that power of keeping it democratized, open, is going to punch through any kind of frameworks that get developed there. Because I think that will, over time, that momentum you won't be able to stop.
But there is something to be said about quality of investors. I mean, there are different stages in all projects, and things are intrinsically less risky after you have a track record and you've made progress. So it's a really good idea, in my view, to segregate your investors accordingly and say who amongst these are more sophisticated and more capable of taking a loss in the event that there is a loss, and give them first access. And then as you get more down the funnel, then you can have a broader and broader group of people. That's the way we've historically done things since the Securities Exchange Act of 1933. That could change with the token economy. In fact, it's been flipped on its head. A lot of this capital is coming from not so wealthy people or new money that's not sophisticated. But historically, it's been done the way that SAFT is trying to do things.
Along those same lines, because crypto's been going up, we don't have a lot of victims right now complaining at the SEC.
Yeah.
And as soon as that changes, there's going to be a lot of the people on the later end of the curve that you were just describing who aren't sophisticated, who are going to be losing their money, who are going to be complaining.
And that creates class action lawsuits.
And that creates the class action
Right.
lawsuits and creates everything. And so what I'm concerned about along those lines is that when that happens, I don't think it's a if, I think it's a when.
Right.
When the less sophisticated investors will complain that they've lost their money, that the SEC comes in and says, and every regulatory body, not just in the U.S., says, you know what, we have to protect these little guys. We can't give them access to this risky thing for the very reasons you just said. And so what I'm wondering is, how do you square a token that is now I think eventually going to be deemed as security and restricted to only those who are sophisticated and capable of carrying a loss, if something bad happens. How do you square that with the need for high utility that creates value? Because if you restrict it just to the sophisticated investors, now you don't have a whole lot of people using it. And you need the broad utility to create the value
Right.
for the project that's underneath it. So
Well,
how do you square
I-
those two?
Yes, this is also exactly, what we are working on. Like today we have only those two categories, right? Accredited investors and retail investors. But this is, that's not enough, right? We need more subcategories there, right? And also if you think about this ICO, it's basically crowdfunding, right? And the difference is here, you can now participate with a very low stake, right? You can buy something for $1,000, right? We're not talking about huge sums here. So why do I have to be sophisticated, accredited, or whatever if I just invest 1,000? That's not appropriate, right? So I think what we need revision of those two categories and maybe creation of another two, right? That will enable people to help to build up those businesses, right? With a little participation, with some limited stake.
Right. That's a good point, is that there needs to be a much better spectrum in terms of accreditation. There shouldn't just be two boxes. There needs to be a spectrum there. Another thing is, just because you're a regulated entity doesn't mean you're actually going to protect people. There's some people who argue the way Tesla operates is not good. I mean, think about it. They don't actually make any money at all, and they just keep issuing more and more stock to retail investors who gobble it up at a very, very high price. And GM and Ford and all these other guys, they just look puzzled, saying, how the hell did they do this? How do we get some of this magic? Because it would be great. Then you also have like straight up scams, which were regulated. For example, Madoff and these things. So just because you live in a regulated market doesn't mean that retail investor is going to be protected. But I understand what you're saying. It's almost predictable. It's like the Thucydides trap of where we're going, where you have this huge speculative bubble, and all these people who aren't so sophisticated are getting really rich, and then they're using that money off of the belief that they're going to get another 10x and another 100x, and when it comes collapsing, the first thing they do is sue, because they're not sophisticated people. And then that class action, what does it say? Well, it establishes U.S. participation. They make the argument it's a security in the lawsuit, so that that does the SEC's job for them. And it's establishing that there's some people that have been harmed. And those are the three pillars that the SEC really needs to get involved. So I think there will be some form of a crackdown. The difference here is that this is no longer a local affair. It's a global affair. And it doesn't really matter what the US says. It's not going to kill the market. There are other players like Japan and South Korea and China, emergent countries in Africa and South America, who really do see the value for these types of things. So you ask, well, how do you create utility if half the market decides it's a security? Well, that just means that you're going to see growth outside of that market. And you're going to see infrastructure as a service and utility tokens more prominent in Asia, Africa, and South America as Europe and North America steps out of that game. And eventually it can be reintroduced, or maybe they'll be segregated for some time. But I think the markets are now too large and too global for any one regulatory standard to change everything. And there's going to be smaller countries that take a chance, and they allow these things to percolate. And once there's money to be made, you'll see Fortune 500 companies lobby for changes in the regulation, like they always do, so that they'll be able to compete on par with these people. It's not too long ago that it was actually illegal to sell things on the internet. If you look at the NSF AUP, it was repealed in 1991. But prior to that, you couldn't conduct an e-commerce. Now the world's richest man made all of his money off of e-commerce. So things change over time. It just takes a little bit to get through it.
You had said that you don't think that SEC will step in and deem everybody a criminal, but what if they step in and say, okay, you guys are all okay up to this point. We agree that you all had fun and made a lot of money, but going forward, all of you ICOs that did your ICO now just need to come back and register as a security. What do you think happens to all those companies that have a utility token business model now that they're security?
They will need to transfer those utilities, those, basically, what is this kind of like receivables or something? They will need to transfer them into some sort of equity title, right? And then again, you cannot have a rule, just one rule, this is how you do it. It will be very difficult case by case. So if you think about it, if you're a regulator, like this is a nightmare, right? You would need to look into every case and look, how was it structured and to suggest like this is the way it should be transferred. So it's a lot of resources and effort for regulators. So like, honestly, I can't imagine something like this happening in Switzerland. They will need to hire 100 more people in the agency.
Yeah, I think that's a catalyst for, again, the regulatory arbitrage. People will be going all over the place to avoid that kind of stuff because it'll stymie innovation, investment, jobs, the whole thing. And it's some of these are so unlike equity. They're more like carnival tickets, They're just like, it's a utility to go in and use a particular arcade or a particular distributed compute or storage or whatever. And so I would see that future very low probability. And I'm confident in this ecosystem that it would still thrive because, there's other places, like Charles mentioned, smaller countries looking at this as a real deal. So you have Isle of Man, Gibraltar, Liechtenstein. You have all these whippersnapper countries that are like, this is happening and we should be a part of this new frontier.
It's the first time I've ever think Switzerland's been described as a whippersnapper country. Just as a final point to that, I think this is the test. If you can actually register and comply, it's not a utility token. If you can't, then it is a utility token. That's the actual test there. It's a thought experiment. Once you have this big decentralized ecosystem with hundreds of people using it, just ask yourself about Bitcoin. Name one company in Bitcoin that if you were to kill that company off, Bitcoin would die. You can't. Even Blockstream, you can't. So similarly, if it's a true utility and it's true infrastructure, there's just no way to comply because of the way the system has been designed. But if there is a core entity and you can remove that entity and it kills the currency or substantially damages it to the point where it loses a lot of utility, like for example, let's say a gold-backed asset or something, the holder of that gold, then it probably is a security. And then you have a very natural way to regulate that.
Okay, I think we have time for one more question.
Whippersnappers, Switzerland.
So it's interesting, there's a lot of talk around regulation.
Well,
I'm curious why nobody's brought up Reg A, Reg A+. When it comes to accredited versus non-accredited. I understand you needed to fit into the right regulation, but what do you guys think about Reg A, Reg A+ as an opportunity for security token offerings?
I missed the first part of that question. Regulation A, so that's the...
So I think we're in like a perfect storm right now where you have the technology one side, regulation on the other with the Jobs Act, where now a non-accredited investor can invest in these up to a certain amount. Kind of to Olga's point, if you're putting up $1,000, hopefully that's not your life savings and you're okay to take a speculative bet. And now there's regulation that supports doing it in a regulatory environment. Then there's kind of the left side where you have the regulation business, right side the technology. Right. Technology is getting ready and is close, and we're seeing it. The regulation's also there, but nobody's really talked about Reg A.
The problem is that's kind of like training wheels up to a proper IPO, and then you're going to Sarbanes-Oxley and living as a publicly traded company, right? So you're just saying, hey, we're going to make it more accessible and easier for people to raise a little bit of capital through more of a crowdsourced way. But at the end of the day, what's going to end up happening at the end of the rainbow is a security. And that security is going to go through a traditional IPO, and Goldman Sachs will be involved in that whole thing. At some point as your company grows, you don't do a Reg A to stop. You do a Reg A to raise capital to grow your business, to either sell your business or to IPO your business, right? So the problem is that that's setting you down a path that's not terribly compatible with the way tokens are working. Because let's say I do a Reg A, where am I going to sell those tokens? I'm going to have to sell it on a broker-dealer licensed exchange like T0 or a traditional stock market. So I've already admitted it's a security. And I'm already living now inside that security framework. So if I'm a utility token, does it make any sense at all to do Reg A? No. But if I'm talking about crypto equity, I think that's actually a good market. And that's something that could work incredibly well. So there is some overlap there. And that would be an interesting thought experiment to see how would a legal framework work where I want to actually turn my equity into a token. And then I use Reg A as a distribution mechanism for that and eventually carry it through to a crypto IPO. Somebody's going to do it at some point. I'm just saying it's important to segregate your assets.
Well, thanks so much, everyone, for joining us. And thank you for all the panelists for your great comments.